Imagine you're about to embark on a journey, one where each decision and choice leads you closer to your financial goals. To navigate this path, you have two main strategies to choose from: active and passive investing. These aren't just techniques, they're entire philosophies that can shape how your money grows and how you approach the market. Today, we'll explore these investment strategies, the complexities of market timing, and how to build and rebalance a portfolio with a mix of strategic and tactical approaches. Let's uncover the strategies that can guide you in navigating the complex world of investing. At the heart of investing lies a fundamental choice between active and passive investing, two contrasting philosophies with distinct benefits. Active investing is hands-on. It's the art of attempting to beat the market by picking stocks, analyzing trends, and making decisions based on extensive research. Imagine a captain at the helm, scanning the horizon for opportunities and steering the ship based on the weather. Active investors analyze market conditions, company fundamentals, and economic indicators, aiming to buy low and sell high. While it offers the potential for high returns, active investing also comes with increased risk, high fees, and the need for constant attention. On the other side of the spectrum, passive investing takes a more relaxed approach. Think of it as setting a course and letting the currents guide you. Passive investing is typically associated with index funds or ETFs that track the overall market, like the S&P 500. Instead of trying to outperform the market, passive investors aim to match its returns, trusting in the market's long-term upward trend. This approach is efficient, with low fees and minimal effort required, making it ideal for long-term investors seeking consistent, steady growth without the roller coaster of constant buying and selling. Market timing is one of the most alluring and challenging strategies in investing. It's the attempt to enter and exit the market at just the right moments to maximize profits and avoid downturns. Imagine it as a complex dance where every step needs to be perfectly in sync with the market's unpredictable rhythm. Some investors believe that with enough knowledge and tools, they can predict the market's highs and lows, buying during downturns and selling at the peak. While stories of perfectly timed trades are legendary, market timing is fraught with risks. The financial markets are influenced by an intricate web of factors, from global events to investor sentiment, making it difficult to consistently predict price movements. Missing just a few of the market's best days can significantly impact long-term returns, and frequent trading incurs higher transaction fees and taxes, which can erode profits. Furthermore, market timing often triggers emotional decision-making, as the fear of missing out or the desire to avoid losses can cloud judgment. For most investors, a steady, disciplined approach proves more reliable than trying to outguess the market's next move. A diversified portfolio is like a well-designed garden, where each plant has a purpose. In investing, this means having a mix of assets that respond differently to market changes. Stocks might thrive when the economy is strong, while bonds provide stability during downturns. Real estate, commodities, and alternative investments like hedge funds or private equity add further diversity, each reacting to different economic factors. The goal of diversification is to minimize risk while maximizing returns. By spreading investments across asset classes, sectors, and regions, you reduce the likelihood that one event, like a stock market downturn, will drastically impact your entire portfolio. Each asset class plays a unique role. Stocks drive growth, bonds offer stability, and alternatives provide both risk management and new avenues for return. Like a well-balanced ecosystem, a diversified portfolio remains resilient, capable of weathering various economic seasons. Over time, as some investments grow faster than others, your portfolio may drift from its original allocation. Rebalancing is the act of adjusting your investments to maintain your desired balance, similar to trimming plants in a garden to ensure even growth. For example, if your stocks outperform and start making up too much of your portfolio, rebalancing would involve selling a portion of those stocks and reinvesting in bonds or other assets. Rebalancing keeps your portfolio aligned with your risk tolerance and financial goals. It's an exercise in discipline, ensuring that your asset allocation remains stable regardless of market changes. Regular rebalancing, whether annually or semi-annually, can help you avoid overexposure to any single asset class, providing a smoother path toward your financial objectives. This discipline helps capture gains when assets appreciate while protecting against the risk of a sudden downturn. Two distinct approaches guide how you allocate assets within your portfolio: strategic and tactical allocation. Strategic asset allocation is a long-term, foundational approach, setting fixed target allocations based on your risk tolerance, goals, and time horizon. This is like building a sturdy ship meant to endure the journey, regardless of occasional waves. With strategic allocation, you determine the proportions of stocks, bonds, and other assets in advance, and make only minor adjustments over time, trusting that the chosen allocation will meet your long-term goals. Tactical asset allocation, however, is more flexible. It allows for short-term adjustments based on current market conditions. Imagine it as adjusting your sails based on the wind, making quick changes to capitalize on economic shifts or trends. For example, if the economy shows signs of growth, you might increase your stock holdings temporarily, while in a downturn, you might favor bonds. Tactical allocation requires market insight and timing, but when used alongside strategic allocation, it can add a layer of responsiveness, allowing you to adapt to changing conditions without straying from your overall plan. Alternative investments, including real estate, commodities, private equity, and hedge funds, are like the hidden treasures in a portfolio. While they may not be as common as stocks and bonds, they offer unique benefits and risks. Alternatives often move independently of traditional markets, providing diversification that can stabilize a portfolio during volatile times. Real estate, for example, can generate income and appreciate over time, while commodities like gold provide a hedge against inflation. However, alternative investments can be complex and require a higher level of expertise. They're often less liquid than stocks and may involve higher fees or longer holding periods. For investors willing to venture into alternatives, these assets add diversity, potentially enhancing returns while reducing exposure to market swings. A small allocation to alternatives can be a strategic way to balance growth with stability in a well-rounded portfolio. In recent years, environmental, social, and governance (ESG) criteria have gained prominence as a way for investors to align their portfolios with their values. ESG investing prioritizes companies that demonstrate environmental stewardship, positive social impact, and strong governance practices. This approach is not just about ethics, it's rooted in the belief that companies with sustainable practices are better positioned for long-term success. ESG investing involves careful selection of companies that meet specific standards, from reducing carbon emissions to promoting diversity and transparency. Many investors see ESG as a way to achieve financial returns while supporting positive change. By incorporating ESG criteria, you're not only investing for your future, but also contributing to a more sustainable and equitable world. Choosing an investment strategy is about more than numbers. It's about aligning your investments with your goals, values, and vision for the future. Whether you're drawn to the dynamic world of active investing, the steady course of passive investing, or a blend of both, understanding the strengths and limitations of each approach empowers you to make informed decisions. By embracing diversification, rebalancing regularly, and considering strategic and tactical allocation, you build a portfolio that's resilient, adaptable, and aligned with your financial journey. From alternative investments to ESG principles, today's investment landscape offers tools and options that allow you to create a portfolio reflecting your unique priorities. Investing isn't just about chasing returns. It's about building a path to financial security and peace of mind. With the right strategy, patience, and commitment, you can navigate the markets with confidence, knowing that each decision brings you closer to achieving your dreams and making a lasting impact.